Oh, hi everybody. I'm here by myself. What a great thing. So what we're doing now, remember, I've adding everything up to my YouTube channel. We had for the undergraduate, oh, there's Keith. Okay, let him get situated. Okay, so I uploaded the video from yesterday. I'm gonna upload the PowerPoint separately today, so you can have it in written format if you wanna look at a PDF. Because it's really an information set that helps you work on your projects and on the presentations, what a good presentation looks like. So I'm going to upload that just so you can look at it. And now I'm going to share to go to the PowerPoint for today's. This is going to be on chapter 6 because we're really moving on for the graduate students. I'm going to get all of their webinars done, get them posted on YouTube. And then all we've got to do is just keep working through the work. And that will kind of have those resources if you guys want to look at them several times. And then I'll try to get more of these PowerPoints, just the PDFs of the PowerPoints loaded up. So let's share. Yay. Is that it? I think that's it. Yes. Okay. So again, now this is chapter 6. So here we go. We're going to talk first about the referent group, and I'm going to use this screen view because I've just noticed this thing starts moving slides around. I don't know what's going on, but anyway. So now we're going to talk about more distributional benefits. So we're really going to want to really get a handle on what's the community. So again, we're focusing in their lingo on the referent group. I call it community, they call it referent group. So we're trying to figure out exactly what that group is. It requires a definition. So the client kind of tells you, oh, I'm interested in this, whether it's a Waianae or it's the whole state or it's Oahu or what exactly is it. You're going to want to identify that by working with the client, or if it's your project, then you identify it yourself. And you can go as big or as small as you want. I'm doing a lot more work for Indigenous people now. This is becoming a topic of interest, is how to benefit specific stakeholder groups, such as Native peoples. Young children is another famous one. Older folks also come into play with some groups. So you can disaggregate however you want, but however that disaggregation occurs, you're going to have to try and track benefits to that group. For example, yesterday I talked about the people in the community that would be gathering sand and rocks and stuff, aggregate, they're calling it, from the beach. There was 120 people that were identified, 120 households or groups that were gathering. I'm assuming it was households. So however they identified that, that's what you would actually have to do if you were going to start subdividing those communities. And the why you're doing this is to really address social equity issues. We're really wanting to do projects that don't always benefit the privileged groups. And this is kind of often what happens, particularly resource owners. If you already own resources, for example, you own land, you own houses, you own businesses, you're going to have a tendency to be able to get even more stuff and do more projects. Because if you have money, you can do more projects. But if you don't have money to start out with, you have a situation which has been becoming a huge worry in the world, is that the poor get poorer and the rich get richer. So we really want to look into our projects to see if we're just helping the rich get richer. And if we are, maybe we want to consider some other options. So that's why we're looking at this. And it's one of the things that's really attractive about this book that I'm using, and why I picked this book is because if you really want to do sustainability, it's not something that economists get too deep into. We will talk about distribution, but we won't really get too deep into social equity discussions. But this information in the cost-benefit analysis allows us to identify, is this really making the community a better place? Because we've really got the majority of the group being made better off and a few people being made worse off, and those are being made worse off, maybe we can get some compensation So that's really what we're trying to get to. So the upshot is you got to figure out who your groups are, and you got to figure out how you're going to identify them in there. You go out to find stakeholder groups. If you can't pick them out and separate them and put them in different groups so you can identify them, any sort of quantitative analysis of these numbers is going to be darn near impossible. So this is the challenge we're facing. So when you're doing this in real life, this is one of the huge data issues. In this case, I often, for example, will do surveys. I've done a lot of feral cat work, and will identify people that are cat lovers who may think that feral cats are great things. And then we identify people that are not into invasive animals running all over the countryside uncontrolled. So we'll have different groups. We'll have, and often those people are conservationists. So again, how people identify themselves is something you may have to do more work on, generally requiring some sort of human dimensions work, like a survey where you identify them, or they self-classify. In another way, you can do kind of other sorts of a network analysis to see who's talking to who do you associate with, who are your groups that you deal with, so you can ask people, who do you hang out with, who do you trust, who do you listen to. That's another way also to kind of identify some of these groups. Sometimes it's done geographically. They just live in certain communities that are more disadvantaged in the entire location. There might be some areas which have already been pegged by the census to be at a disadvantage. They may self-identify. Native peoples, for example, may have tribe affiliations that they put forward, and not just neighborhoods. So there's a lot of ways to do this, but suffice it to say, we're not going to talk about how you identify them. We just know we got to disaggregate them. Okay. So let's just talk about this difference between referent group benefits and efficiency benefits. Because I noticed some of you, in turning in your assignment 3 and homework 3, have kind of messed this up a little bit. So what we're saying is that efficiency net benefits are really looking at global efficiency, that we're not causing pollution, that we're not having benefits that we would like to have more of, but we're not getting them because the market doesn't supply them, or we have markets that are not working well because there's a monopoly or a monopsony, some sort of power structure that's preventing us from working well, versus some sort of non-market inability to deal with value. So that's the kind of two things that cause efficiency problems for us. So if you have all the referent group benefits and the non-referent group benefits, add those together, they should be equal to the efficiency net benefit. So you start with your efficiency net benefit and you subtract out the benefits that go to anybody who's not living in the community or not part of the referent group. That generally means, in most cases, profits going out to foreign owners. Taxes stay in the community. So all taxes paid by foreign owners stay in community. All wages earned by workers that are working in the project, those stay in the community. What goes out of the community is profits earned by foreign operations that don't live there, and they could be foreign just that they don't live in town. I'm not meaning foreign as far as another country necessarily, but are just not part of that group. So those benefits are leaking, what we call leaking out. That's a sizable problem. So we definitely want to subtract that out because that's not accruing to the community. So here's a consistency check for those of you who had problems with your homework. A lot of you got the efficiency net benefit right, but didn't get the referent group because you were confused with what the difference were. So the referent group is only different from the efficiency if there's a foreign owner. If there's not a foreign owner, then they're the same. So this kind of provides a consistency check. Normally I start with a project and I just keep adjusting them as I go down. Half of you got some problems wrong when you submitted them. So I'm not sure what you were thinking, but you got more confused usually as you went down. Some of you not, but most of you. efficiency in referent was causing you a problem. So this is why we're talking about it. It's very powerful because we like to keep local dollars in local community. We talk about this all the time. Buy local. It matters. So this is very important for an economic development strategy, and it also generates what we call the multiplier effect. So every time you spend $1 in the local community, it circulates around 2.5, 2.6, 2.7 times. As I buy from you, you buy from her, she buys from him, he buys from me, and we just spend the whole dollar going back and forth and round in the community. So this is why we love local. And this is why we don't like foreign investors, because they take the profits and go home. Not productive at all. So not only are they influencing our decision-making by engaging in lobbying or whatever they're doing to try and get things to go their way, they're also taking their money and going home. So we really like people that fit into our local community, and sustainable development is really hinged on having local businesses that keep the money at home. So we really like that, and that's why we've introduced this referent group concept. And in my belief, it's very important for social equity and therefore for sustainability. And that's why we're using this particular book, because it puts forward this approach. So how do we kind of get going on this thing? Well, why are we doing it? Well, the evaluation of the project is only looking at market stuff, right? But we might have other stuff that's not being captured, like pollution costs, indirect tax revenue changes. So not direct tax revenue. That's definitely captured in the project BCA, because that is a direct monetary thing. But we may have some indirect tax revenue. Remember when I said we spend this dollar 2.5 times? As that thing goes around, it's generating more taxes than just that original dollar that it started with, right? The original project generated some taxes. And then when I buy from you, that's another round of taxes. So that $2.6, $2.7 is distributed equally through, not necessarily equally, but through the community and also to the government. So we really like that. That's that indirect effect of the multiplier. It happens for taxes and it happens for profits of other businesses. It also happens with employment benefits, because as I keep spending the money in the community, you're able to hire someone else, and it just keeps, all the positives keep getting bigger. And it also helps us account for the negatives. Efficiency really accounts for some of these negative things that we have to correct for. So that will carry down to the community, because the community is sitting with all the leftovers. If you create pollution as a result of a project and you're a foreign owner and you just go home, you're not the one sitting there. The community's got to bear this burden. So this is very problematic. So this is why we like to have this referent group analysis. It's very useful. Now, basically, again, let me run through this because we are having a few bits of confusion. The project analysis is done first because that data is the most readily available. It's straight market data, costs and benefits. You can call up on the phone. You can figure out what the costs are if you're doing an estimation, or you can just talk to the business and they'll have estimates for you. If it's the government, they're probably going to have some sort of project cost and benefit estimate of direct market things. Then you figure out what goes to the private investor. Okay, so the private investor is basically going to get what the project earns minus the taxes they have to pay if it's a privately owned project. So there you have it. Then you do the efficiency analysis, where you're including these non-market valuations, such as the cost of pollution or the cost of positive things. Like if you bring in a company and they build this road that you really needed, that now everybody can get to work faster, or some bridge that we needed, oh, now we can get to work faster. There's a benefit to that, but it's not a market benefit. It's now I have to spend less time driving. I can save time on my trip to work. I save gas on my trip to work because it's closer. I'm not sitting in my car for twice as long. So all this type of stuff could be really valued using shadow prices, because that can be costed. Non-market valuations, is another way that you can actually try and look at valuing things. Any way that you can value stuff that is not priced appropriately in a market, that's what we're trying to do. Then once we get that efficiency analysis, we're going to know where that private investor is already, because we've already done the private analysis. We'll know what their profits are, and we will know if they're foreign or not. So then we can go ahead and move right to the aggregate referent group net benefits. And then once we do that, we can start then allocating them out to the various stakeholder groups, who wins and who loses. And that really allows us to determine, did we increase the social welfare because it was a Pareto preferred situation, as we looked at all the winners and losers, that there was a Pareto preferred setup. So therefore this project, not only does it generally have a great MPV, for example, but it also makes this community better off. It increases our well-being. So that's pretty powerful if you're looking at sustainability. And that's the types of statements we want to make. That's the types of projects we want to do. And the more that you can provide these links and demonstrate this, the better off everyone is. So here's kind of what it sort of looks like. So here's your project analysis. You had benefits of 100. Every year operating costs of a -60. So you get net benefits of $40 a year, initial cost of 100. So when you do your MPV, you're really looking at a net present value of all these streams of income, and then you subtract the year 0, and you end up with an MPV of $73.18. It doesn't seem like a lot, but if you look at the IRR, 29%, that's a pretty good IRR. You're really doing pretty good. Why doesn't the MPV look that great? Because you only spent $100. So, you know, it seems like it's not that much money, but considering I only invested $100 in the project, not that bad. Not that bad. And let me just say, there's one thing some people are messing up. It's the benefit cost ratio. In the benefit cost ratio, all you're doing is making a ratio of all the net benefits. So you're discounting all the positives. And then the $100 doesn't need to be discounted. So it would be these discounted benefits, which should be $173.18, divided by the cost, which is 100. We ignore the negative sign. That will give you a benefit cost ratio. Why do we do that? Well, the reason I just explained. You look at this $73 and you're like, is that a lot? Because you don't know how much this project costs. So when we're looking at cost a lot across a lot of projects, is $73 in NPV, is that big? Doesn't sound big to me. Versus one that returns, I don't know, 4,000. I'll be thinking, oh, that 4,000 one is really great. Well, it may not be as great as the one that returns $73 if it costs a lot more. So by making a ratio of discounted total benefits and discounted total costs, of course, year 0 doesn't have to be discounted, so you can put it in its full value, get rid of all the plus and minus signs. You can really say the bang for the buck. If I spent $1, I got $1.73 for every dollar I spent here on this project. So the benefit cost ratio was 1.73. So for every dollar I spent, I got $1.73 back. So I made back my original dollar plus an extra 73 cents. So that actually sounds a lot better, I think. And then when you go down to the private one, you notice the only thing that I'm removing here is the taxes. So when I'm doing the MPV for the private analysis, this is why it drops. And you notice here at the 5% is now $29.88. So $10 made a big difference because you were only investing $100. So that 10% drop due to taxes, this is why. Then if you were looking at efficiency, let's say it has no efficiency problems. No, we're adjusting. Okay, we have a shadow wage of $2, right? So we have to adjust the shadow wage, and I'll explain that to you in a minute. So what you're saying is somehow the prevailing wage rate is $3, but somehow this thing was only valued at $2. So we really got an additional $20 out of that because we got this extra dollar for these 20 hours of labor. So we got this extra $20 over and above what it really should have cost us to get these workers. So somehow we attracted workers that were not really doing much, and we were able to plug them in and get them this money. So we actually got an additional benefit because those resources would have gone unused, that labor. But now we roped them in because they were willing to do it for $2, and it worked out. So we got an extra 20. So that's why this operating cost is now -40, because we've adjusted it for the shadow wage. And I'll give you the rule in a minute. And you see then, efficiency-wise, this is even a more attractive project because it produced more net benefits. So it would have a higher NPV and a higher BC ratio. And then here, what do we have? We have the aggregate net benefits was 30, which must have been the tax rate. Tax rate on something, I'm not sure on what, because I don't have the whole project. But so aggregate wise, this is where we're at, and how is it distributed? Well, $10 went to the government for taxes, and $20 went to the laborers because they were willing to work. I guess they were willing to work for $2, and we paid them $3, so they got an extra $20. They were willing to do it for $2. They were cheaper laborers, but we paid them $3. So they got an extra. So that's how it was distributed. So what does this tell me? Probably a foreign owner. Foreign owner. Because they're not the same. If they were the same, you would have a domestic owner. But they're not, so we have a foreign owner. So you can tell a lot just by looking at these things once you know what you're doing. So that's kind of, this came from the book, so I'm trying to kind of link you back to what's happening in the book because we're not going to have a separate write-up now. We're just going to be concentrating on the book. Okay, so again, tax and financing flows generated by the projects are distributed between the private sector stakeholders and the private and public sector, right? So some of the private sector may be excluded from the referent group because they're foreigners. That's what I'm going to call them, but I'm not implying that they may live out of the country. They're just not part of the community. So you could call them outsiders if you want. I'm going to call them foreigners. Okay, so that's the first thing you do is figure out, are they in the community or not? And if they're not, then efficiency is going to be different from referent group because the referent group is going to be smaller as those profits leave with their owners. The next thing is really looking at shadow prices and market prices. Did you really get paid your market price? Is your market price accurate? What was the shadow price, which is really what your opportunity cost is versus what you were actually paid? If your opportunity cost, if I would have worked for $2 but I got $3, then I got some extra benefits because I was willing to work for $2 but I got $3. So that's good. So that's really what we're looking for. So let's kind of get down to some specifics because I know this gets difficult. So if tax revenues are among members of the reference group, then we just net them out for the aggregate. For example, some winners and some losers. So if we'd had a project that reduced the amount of gas that we're using and we give farmers a tax break for gas, then the government may suffer from this project because they make less tax revenue, and that happens, right? So then that would have to be a negative. And then the farmers also then, because they're using less gas, they get less gas subsidies, so that's another negative. Right? So you've got to really look at, okay, there's some losers when we use less fuel. There's less government taxes being paid. This is true. If we use less gas, the government makes less taxes. If we smoke less cigarettes, the government makes less taxes. But we assume there's going to be positive benefits because we've instituted this idea that we want to use less gas and less cigarettes. So there must be some positives. So then we're going to have to go and look for those positive benefits. In the case of gas, what's the positive benefit? The non-market benefits of using less fossil fuel, less global climate change. Very difficult to quantify, but real. Also, less cigarettes. Very positive benefits of less smoking, less public health problems, less public health expenditures. But those benefits are much more difficult to quantify because we've got to really look at who's the stakeholder groups, how much are they, they're hard to value. Very difficult, very, very difficult. Figuring out the loss in taxes is the easy part. So these become a little more challenging with these really complex BCAs. So you got to think about all this. It gets more complex. And if the tax flows involve transfers from the reference group and the rest of the world, the net is recorded for the domestic government. Like, for example, if you're having tariffs and subsidies, like, oh, we may have a project that may result in less importation of this thing, but more exportation of that thing. So exports may have taxes in other locations where we have to pay taxes to the rest of the world. So that goes up, but we pay less taxes for our imports coming in. So we would have to net that all out, like what we're paying and what we're not, what we're being paid. We've got to net that out. And that will happen in complex trade examples. We are not doing much of that in this class, but this can get very complex if you're actually looking at trade. And this is why these trade negotiators, you're hearing them now on the news because these are very difficult situations. How do we do trade? So that's very difficult because there's a lot of in and out that you're going to have to net. So it gets very difficult. And then private financing are also relevant for the referent group. For example, if a firm comes in and they finance with local banks, then local banks make more money. If they finance with foreign banks, the foreign banks make more money. So sometimes financing becomes an issue in a big private project because they'll finance it locally. Often they don't because they don't know the bank. They have banking relationships and they'll tend to go with their usual bank. So a company, my company has relationships with my banks. They know me, I know them, all my lenders. When I work with my finance people, when I work with my brokers, I have one mortgage broker who loves me. If you say my name, she will light up and thinks I'm great. And I try to put all my stuff through her. All my buying, I try to move it through Home Depot because I get points and I'm in the Pro Club and blah, blah, blah. So you'll see that they'll have these relationships. But when a partner is a domestic and that partner does a lot of lending, that money, that profit will accrue to the reference group. Okay? So shadow price versus market price. Oh my gosh. If the shadow price or opportunity cost of an input is less than the market price, then the input owner is receiving a benefit. I'm willing to work for $2, but you're going to pay me $3. Why are you paying me $3? Because that's the prevailing equilibrium wage. But I'm unemployed. But now, because you want to have projects that produce employment, you're going to force this investor to hire unemployed. I would be willing to work for less, but I still couldn't find a job because there's this problem with not enough jobs. But now you come in, you're forced to give jobs to unemployed people, and I'm really working for more than I really expected to get. I would have worked for less. So that's a benefit, and that shows up as a reference group benefit. And so therefore we do like to bring in businesses who are trying to provide employment. One of the most famous ones in isolated areas are call centers. A lot of people want to hire or want to attract call centers because they employ a lot of people. Some of the best call center workers are from the Philippines. I mean, have you ever got on the phone and you're talking from somebody in India on the phone call and you can't understand them? The best ones are the Filipinos. They're very good at service. So a lot of call centers will be located in those areas. So that is a situation where they're trying to attract people who will produce jobs, and people are willing definitely to go work. And sometimes you'll actually give them what we call a net benefit of over and above that wage rate, because they were willing to work for a cheaper wage, because they had a low opportunity cost in the Philippines. They have a low salary because there's not a lot of opportunities there. They have a very high unemployment rate. So maybe they can get a job where they make even more than what they minimally they had to have to actually take the job. So that's actually a benefit. But if the opportunity cost of the input is more than the market price, then you're attracting resources away from other uses. If you're attracting people from other jobs that they're making money, so you have to pay them more, then that's costing us, because we're actually having someone come from that job over there to come to this job over here. That's actually kind of a loss, particularly if you're hiring an outsider to come in. You could have worked in your community, but I'm going to hire you over here. That's going to be expensive for me. That's going to be a cost. So that's what you're really looking at. And it's this slide that helps you define how you're valuing that person's labor. Okay, so let's get to an example. Here's an example on page 127, so you can follow with it as you go along, because this is similar to the assignment questions. So the firm is paid $110 to make a walking track that cost them $100 worth of labor to make. So the project produced a net benefit of $10. The revenue was $110 to the firm, and the costs were $100, so they actually had a net profit of $10. So the project BC is $10. Then what happens? The consumers value the track at $120. So this track is valued more than it cost to make it. So that means we got a positive externality that we're not charging for. Everybody loves that track so much. They love it more than it cost us to make it. That means that's a positive externality. Right? So that should be accounted for in the efficiency analysis and in the referent group analysis, because we're making people even better off than what we actually spent to get this thing. So that's a plus. That's called a positive externality. We're going to add that in as a positive benefit, that $10 benefit, right? Because we only paid $110, but it's worth $120. Scored already. Then the labor would be otherwise unemployed, okay, and make $50 for their non-market activities. So you paid them $100, but because they're now employed, they're going to have to spend $50 of that to go back and do all this other stuff that they used to do before they had the job, like pick up the laundry and cook at home and all this kind of stuff. This is the working mom problem. It's nice to have a mom that stays at home, but we don't pay them. So we don't understand how valuable they are till they're not doing it. We've got to go find the next opportunity to get this stuff done, which is hiring somebody. Very expensive. Babysitting, extremely expensive. House cleaning. Believe me, house cleaning costs about the same as house painting in the projects I've done. So house cleaning, very expensive. So difficult. So let's go through what we did. So I said the project was $110 we paid the firm, and it only cost them $100. So the net benefit of the project based on market prices was $10. Then the efficiency, let's go to the private BCA, was $10. The firm made $10. We don't know if they're local, but we think they probably are, because we go to the referent group BCA and we don't see adjustments because it says all stakeholders are part of the referent group. So I guess we didn't use a foreign firm. Then we go to the efficiency. So here's the project benefit cost, right? Then you get another 10 because of this 120 value. The thing is valued at 120, but we only paid 110. So we get $10 because our consumers say it's worth that much more than we paid. That's what they said. We're going to so believe them. We got benefits that are greater than the opportunity cost, the resources we used up, right? So that's a benefit. And then $50 for the labor, because while the labor was paid $100, they had to spend $50 that they used to not have to spend to do the chores at home. So the efficiency is $70. And the referent group is also $70 because all the stakeholders are part of the referent group. So that's how you do the BCA. And these are the aggregate values. But if you actually look at the efficiency BCA and the referent group BCA is where we start splitting them out and add them up separately. And you might, in your homework, make a, in your project, make a table if distributional benefits are important to you. And for some projects, they definitely are. Okay, one more. We're going to do one more so we know what we're doing. Okay. Again, these are in your book, but I'm going through them because the assignments at the end somehow look very similar to my examples. Imagine that. So clever. So here we are. We've got a foreign company that makes a smelter costing $100 that will use $50 worth of power. And it produces output worth $400, and you pay $100 in taxes, the company. Okay. So, and then the power costs $20 more than its shadow price, right? Because it is sold above shadow price, right? So its opportunity cost is less than what we're selling it for. So we've made a benefit on it because we're really selling it for more than we value it at. So wow, 20 bucks straight in our pocket. So the project BCA, $400, smelter produces $400 worth of stuff, $400 worth of stuff. It costs $100 worth of operating expenses other than power, and then there's another 50 bucks for power. So the project produces $250 in net benefits. So let's look at the private BCA first, because this is, I don't know why I think the book does them in this order, but I usually do the private BCA first. So the profits are $250, and then you have to pay $100 in taxes. So the firm makes $150 of this. The government makes $100. Then we're looking at efficiency. So the efficiency starts with the projects and adjusts for any non-market stuff. We didn't have any non-market stuff, but we did have an instance where we sold it for more than the shadow price. So we had $20 in what we think of as pure profit. I could have got this for $20 less, but somehow I paid $20 for it more, or it made $20 more. Wow, great, $20 in pure profit from this thing. So I add that in there, and so the efficiency is $270. But the referent group is not the same as the efficiency, BCA, because the firm was foreign. So we only get from this project right up here and from this owner right here, $100. So we get this $100, plus we get the $20 for that pure profit from the power selling above shadow price or opportunity cost. So we've calculated that in. And in this case, the community makes much less on this than we would have if we would have gone with a domestic firm. And again, this is why we like domestic firms, because we would have had that 150 still running around in our community, but it's gone. It went back home, so we don't have it. So that's pretty much what we're doing in chapter 6. The assignments come from the back of the book, no more homework. So this will go so much faster because we're not setting up these giant MPV things. We kind of now think we know how to do that, and we're moving on to special interest topics, and one of those is the distributional benefits. Any questions? I'm going to stop share. So Keith, any questions, or are you ready to go?
as much as I can to say I'm ready to go.
I think once you get into it, you'll see it. It's pretty easy.
Yeah.
The biggest problem with this is not calculating this thing. It's going to kind of get these assumptions. Like how many people you're going to hire, where are you going to hire them from, where do they live, who's the groups, how does it break down, you know? That we're going to just give it to you in the problem. But when you do this in real life, this is really the challenge, is identify who, where, and what. So that's why you need not to ignore this when you're doing a controversial project like the one I talked about yesterday where we were going to dredge the lagoon. Had a really big hot button because there was 1,200 families that were going to lose money and they were going to be really upset about it. And they were going to hit on any negative that they could to argue against this project. And this is what's going to happen. Particularly in this state, we have a long history of this kind of social discourse of all sides. And this takes us a long time to get out because a lot of times we don't admit it in a room. We need to actually go in the parking lot to hear who's mad about what and what people are actually thinking. I know like the GMO debate, there's been a lot of charges back and forth. And last I heard, we really were kind of inconclusive about this. Most of the scientists I talk to will tell you they're not totally convinced that GMOs are so horrible. And so getting this data of, you know, what are the negatives and positives of this stuff is very expensive. So that's why I recommend you don't ignore it. You at least acknowledge it's there. And if you're not able to put it in your little distributional thing, you at least try to say, well, this is the group that's going to be affected. I can't value it, but they'll be affected. Anything you can do to address that, and at least mention it or acknowledge it, will prevent this kind of angriness thing. Because people get upset about these things. Remember what I said, nothing is going to be perfect. No allocation is perfect. There'll always be someone who's mad because it didn't go how they wanted it to go. They didn't get what they wanted. And another thing you will see that's very, very real is a special interest effect where the people that are most affected will be in there arguing. And then a lot of times what's done produces a little bit of cost for a lot of us because that vocal group that gets most of the benefits is very vocal and the cost is borne throughout the community. So this creates kind of an unequal situation. Farm subsidies are like that, where the farmers argue that they need to have higher prices. So we artificially support the prices of certain things. And we don't even realize that this is tacking 10 to 20 cents on every pound I buy of whatever it is. I don't even know it. So I don't really notice it because it's a very small amount. But at the end of the day, you're really taxing a huge group of people to benefit one group of farmers. This is for years we had tobacco subsidies. So we're taxing cigarettes, but we're subsidizing tobacco farmers because this is what they always did. I think we finally eliminated those, but still the idea that we kept subsidizing these farmers when in fact, if we don't want tobacco products, then we should probably not subsidize those farmers. But everyone felt bad about ruining the lives of that particular group. And as a result, we all bore a cost for this. We all paid out of our government tax dollar to support tobacco farmers, even though we say we don't want tobacco products being used. So we do very funny things like this. Beef is the same thing. We say we don't want meat because it causes a lot of global warming issues because of the methane production and blah, blah, blah. But what do? We give very cheap grazing leases all through the West. So the cattle producers have this cheap land to graze. Okay. This is the kind of stuff we need to start mapping out and doing some solid thinking on why do we have this agenda that's inconsistent with our sustainability goals. So we need to really look at these distributional benefits. And I'm sure those ranchers would be very upset because you're messing with their livelihoods. But at the same time, if we really are into meatless Mondays and meatless Tuesdays and on, then maybe we should make it more expensive to produce cattle, and we would produce less of them and we would have less problems. So these are the hard discussions that you can now start to investigate, because you're now going down at the community level into the different groups and really trying to look at what's really best for our well-being and who's bearing the brunt of what. So any questions? You'll see that it's very useful. Of course, these assignments are very simple, but in real life, there's some real powerful tools here to actually look at some of these distributional issues and really come to grips with some of our policy things that get a bit out of whack, because we have all these business people up there lobbying and are very effectively pushing a case for their group. And the little consumers who bear these burdens through all these things don't realize it's happening. So this helps us identify the winners and losers. So when we're pushing policy, we're able to explain to policymakers about these distributional benefits. And it's very useful to have more social equity alignment. Because if we need that, we need those distributional discussions. Okay, no more questions. We're going to end it and I'll post it and keep on moving forward.
Okay, thank you.